Hello, folks. I'm just going to give everybody a minute or two to file in, and then we'll begin our presentation. Hey, my name is Megan Coelho. I'm the president of Advice Chaser. Before we introduce our guests and get started here, I need to do just a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. So we are thrilled to bring you this educational presentation today. Just so you know, attendees are muted, but we do encourage you to ask questions using that chat box. It should be either at the bottom or the right of your screen there. The presenters will answer those queries during or after the webinar today as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. If we can't get to your question during the event, we'll make sure someone reaches out to you afterwards. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. So next, I'd like to introduce you to today's presenter, who is Wes Bangs. He's a financial advisor at Momentum Independent Network. And as a financial advisor, Wesley has developed and refined a process that puts all the pieces of the financial puzzle together for his clients. As a certified divorce financial analyst, Wesley knows the financial ramifications of a divorce can be devastating, but with proper planning and expert help from professionals specializing in financially equitable divorce settlements, he helps clients increase their chances of arriving at a settlement that fully addresses their long-term financial needs, as well as their spouses. A certified divorce financial analyst, or CDFA, can forecast the long-term effects of this settlement. They're trained to advocate for both men and women. They also interpret the numbers and help lawyers build a strong case that's in the client's best interest. So Wes, I'm going to hand it over to you now.
Well, thank you and welcome everyone. Thanks for joining me today. The goal today is to accomplish two things. One is to educate you and the other is to motivate you. And I believe once you're educated, you will be motivated to make those financial decisions that you're facing. And what I've found with most of my clients, they have the same concerns. Am I going to be financially okay today? And am I going to be financially okay in the future? I've been in the financial industry for 22 years. And in the beginning stages of my career as a financial advisor, I had many clients come to me after their divorce, hand me their divorce decree, and here's how the assets are being separated. Immediately, I recognized some of the problems with trying to separate the assets. The way that the court typically ordered this was a 50-50 split of each account. And by doing it the court's way, the client had to pay excessive fees, penalties, extra taxes. The option to avoid this was surely never gone over with the client. I hit my breaking point when this happened to a client and a family member of mine, the same thing. She handed me the divorce decree, the final separation of assets. They both got a 50-50 split all right, but because of the non-liquid assets, the structuring of these accounts, she incurred an $18,000, 10% early withdrawal fee and an extra $12,000 in taxes that could have been avoided. In my experience, the lawyer, is hired to get your divorce done legally. If you want 50% of the assets, that's what they're going to try to get for you. What's always overlooked in the details on all the assets is how it affects the client today, but 10 years in the future as well. 5 out of the 10 clients that came to me with their divorce decree, it was all done with excessive fees, penalties, and the frustrations could have been avoided if they'd known all the options available to them. So 11 years ago, I enrolled in the only credentialed financial divorce program out there to become a certified divorce financial analysis. I swore this would never happen again to another client or somebody I potentially talked to. And here's what we're going over today, just avoiding some of those errors in the divorce settlement. My disclosure, note that I'm not an attorney, nor am I practicing law. I am not a tax advisor or a CPA. I work with clients and provide data to those professionals. I do not give any legal advice on what you need to do during the divorce. That's where you need a divorce attorney. My job is to examine and analyze the financial issues of divorce, providing clients and their attorneys with data to help strengthen the case and avoid those common pitfalls of divorce. The data includes valuable insight on how the different settlement options impact our client's short and long-term financial condition. So I find for most of my clients, the number one issue is maintaining a positive cash flow. In other words, paying the bills on a monthly basis, not only the day after divorce, but 5, 10, 15 years into the future. In order to meet those cash flow needs, there are 3 sources of money that may be available to you as a result of your divorce: child support, spousal support, and marital property. The first source of income that we're going to cover is child support. Child support is determined by guidelines that are mandated by each state. In Texas, child support is based on your gross income from all sources. Once you've calculated your gross income, you can only deduct 4 things: 100% of your Social Security withholdings, 100% of your federal income tax, as you're a single person claiming one exemption and the standard deduction. The third is medical insurance premium for your children or child only. Does not include you or your spouse. The fourth thing is union dues. And child support is based on 3 factors: age of the children, income of the parents, and family size. These factors are plugged into a formula. So if you have 1 child, it's 20% of the payer's net income. 2 children, 25%. 3, 30. Goes all the way up to 6 children, not less than 40% of your net resources. And these percentages change if the payer is paying child support to another parent for other children. The monthly child support net resource figure is used to determine child support is capped. The net income is currently capped at $110,400 of annual income. That's $9,200 a month, which means the maximum child support for 2 children would be 25% of $9,200, which is $2,300 a month in support. This supplies a recommendation for the court. Child support guidelines are pretty much set in stone. So there's not much wiggle room except upwards. You cannot negotiate below the mandated guidelines. And I read here in the past divorce case, an NFL player in this area had to pay over $30,000 a month in his child support. An important aspect of child support, it is not taxable income to the person receiving it, and it's not tax deductible by the person paying it. However, I do want to caution you that child support formula does not take into consideration the child's actual expenses, extracurricular activities, private school tuition, college funding. They're not factored in, to the formula. For example, I have a client right now whose 10-year-old daughter is in Pro Spirit. Her cheerleading expenses right now are over $500 per month in training. competition fees, costumes. My client tells me that the costs are only going to increase as her daughter gets older. These expenses will not be taken into consideration when the court calculates the child support. And as a CDFA professional, I help my clients determine what costs may not be addressed by the formula. And then I help find alternative solutions to cover those. The point is that child support's not going to cover your child's needs. You need to know what will. Another source of income or expense for many of you is alimony, also known as spousal support. Texas calls this spousal maintenance. Remember when I said that child support is written in stone? Well, spousal maintenance is the exact opposite. It's a very gray and subjective area. However, most heavily weighted factors are the need and the ability to pay. And how many in you right now have a written detailed budget of all your expenses? I usually don't see when people walk through the door that they have one. And in fact, they usually have misinformation with regards to spousal maintenance when they walk through my door. And more importantly, they have a lack of supporting documentation. But while you're married here in Texas, each spouse must support the other spouse. While the divorce is pending, Texas courts will usually order the spouse with the higher income to provide support payments to the spouse with the lower income. These payments, temporary alimony, you will receive. It'll go away once it is final or the court orders it to be changed. In Texas, if you've been married for at least 10 years, you're entitled to this, unless you're disabled or have a serious health problem making you unable to work. Spousal maintenance is capped at $5,000 a month or 20% of your gross income, whichever is less, for a maximum time period of 10 years. And this is the maximum amount of money that can be awarded. You're not guaranteed this amount. And spousal maintenance can be reduced or eliminated if the person receiving the maintenance gets even a minimum wage job. One of my clients, her husband was offering her $30,000 per year in spousal support for 5 years. On my direction, she prepared a budget and said that this met exactly what her needs are. After I reviewed it, I found that she left off COBRA health insurance premiums, which she would now have to pay, as well as several other key expenses. Also, she wasn't sure how to factor in inflation, taxes, so she left them out. We all know what it costs today to buy stamps, milk, movies. It's not going to cost the same next year. When I ran a cash flow projection for her based on the new numbers, she was going to run out of her settlement money in 3 years. They were able to get an extra $8,000 a year in support because of the financial charts that we provided. So how do you know how much spousal maintenance you will need or can pay if you don't know what your expenses will be? You need to establish a detailed budget so you can do a proper cash flow analysis. Aside from determining the ability to pay, you need to understand some of the important issues with regards to spousal maintenance. First, it can be set up as modifiable or non-modifiable with respects to the amount and the duration. If it's modifiable, either party can go back to the judge and ask for a modification if there's any change in circumstance. If it's non-modifiable, then the judge's door is locked on the issue and neither party can ask for it to be changed at any time in the future. Let me give you an example. Let's say that Mary currently has a minimum wage paying job. John is paying Mary $20,000 per year for 5 years in a modifiable spousal support. In the second year after the divorce, Mary finds a job that pays $55,000 per year. Due to the change in circumstance, Mary's increased earnings, John may be able to ask to have that spousal support reduced. And there's no two divorcing couples that have identical circumstances. You need to know what type of spousal support would best suit your situation. You should also know that spousal support changed in 2019. It's no longer treated as taxable income to the person receiving it and tax deductible for the person paying it. That went away 2 years ago. The last point I want to make regarding spousal support is how to protect it. If you're relying on spousal support to cover all your cash flow needs, it's very important to protect it in case your ex-spouse dies or becomes disabled. Let's say, for an example, your ex-spouse dies only 1 year after your divorce, and you were counting on support of $30,000 per year over the next 5 years in order to meet your needs. Now, where's the income going to come from now? You want to make sure that the support is protected, and it's protected for the correct amount. And that's another area where a CDFA can help add value to your situation. The third source of income in a divorce is property. Texas is a community property state. Each state is either a community property state or an equitable distribution state. Equitable doesn't always mean equal. It is, however, supposed to mean fair. Some divorces do settle at a 50-50 split. However, it can make a huge difference which 50% you get. In other words, all assets are not created equal. For example, I have many clients that come to me determined to keep their house. However, if you can't afford the maintenance and upkeep, you may be forced to sell that sooner than you anticipated. And then who do you think pays for the closing costs and the commission? They do. They're responsible for 100% of those costs, which before would have been shared with their ex if they sold it at the time of divorce. And what if they're forced to sell in a time of need where the real estate market is down? If you want to keep the house, you have to determine if you can afford to keep it. You need to know the answer before you sign on the dotted line. And if not, the decision could, land you in bankruptcy or in that situation in the future. So I'm going to cover some of the basics with regards to property. The first thing you need to know, there's two kinds of property, marital and separate. Everything that is marital will go into the marital pie, and that'll be equally divided. Anything that's separate property will not. The distinction between the two, like spousal support, is another gray area, and it should be discussed with your attorney. But I'm going to spend a little time explaining how the courts typically define separate property. And separate property is anything that was gifted during the marriage, inherited during the marriage, or brought into the marriage and kept in either spouse's separate name. Let's take a look at this example. My friend Karen got married 10 years ago. She was in love. She told her husband, what's mine is yours and what's yours is mine. She changed the title on the cottage from her name alone to both of their names. This is what's called making a presumptive gift to the marriage. Now the cottage will likely be part of the marital pie and up for division now that she's getting a divorce. The diamond ring that her husband gave her on her 5th anniversary, on the other hand, is considered her separate property, and it's not included on the list of items going in to be divided. Now, if it's a 10-carat diamond ring, her husband may say, look, that wasn't a gift, it is an investment. How about the inheritance that Karen received 5 years ago from her Aunt Millie? She left it in a trust account in her name. Do you think that would be separate or marital? It's separate. It's not up for division. What if Karen had taken the $15,000 inheritance and used it to renovate the kitchen in her marital home? She could ask her attorney to subtract the $15,000 from the marital portion, but the courts are likely to rule that the inheritance became marital property when she invested it in the home. Here's another tricky part. Any increase in value in the inheritance or the separate property is considered marital. Aunt Millie left Karen $15,000, which grew to $20,000 by the time of her divorce. The $5,000 in growth is considered marital in Texas. And anything that's not considered separate property is considered marital. As long as it's accumulated during the marriage, it's going to go in the pie to be divided. no matter whose name it's in. So the 401k contribution that comes out of my paycheck goes directly into XYZ fund in that name. That's marital. How about my wife's pension? That's marital property too. And let's take a closer look at an equitable division of some marital property. What you need to know when you're analyzing property in the terms of how it can supplement your cash flow needs. And as I mentioned earlier, all assets are not created equal. You only have one shot at negotiating a property settlement. So make sure it's going to work for you, not only now, but in the future. In many divorces, the biggest question is who gets the marital home? Should the wife get it? Should the husband? Or should they sell it and split the proceeds? And the answer is not always easy, or is it clear? There are three options for the home. You sell the home, have one of the spouses keep the home while the other spouse gets assets of equal value, or both spouses continue to own the home. The Tax Relief Act in 1997 changed the tax ruling regarding the sale of a principal residence. More recent tax law changes could reduce the capital gains to 15% for most taxpayers, but that's likely to go up. Now taxpayers can exclude a certain dollar amount of capital gains when they sell their principal residence. $250,000 per person, or $500,000 for a married couple. Now you must have lived in the house for 2 out of the last 5 years in order to take that exclusion. And that amount can be excluded, it depends on the filing status when they meet all those requirements. Look at an example of how taxation could take a bite out of your divorce settlement. June and Jan were getting a divorce. They had 3 assets: a cottage valued at $600,000 with equity of $500,000, a 401k worth $50,000, and CDs worth $550,000. Since he wanted to keep the CDs, Dan suggested that June get the cottage and sell it. Everybody, including the attorneys, thought this sounded like a fair and simple solution. So that's what they did. Let's take a look at really what happened when June sold that cottage. What Dan never told anyone, because nobody even asked him the question, how much should he actually pay for that cottage? It turns out that Dan bought the cottage 15 years earlier for $150,000. There was a $450,000 capital gain. When June sold the cottage, she claimed the capital gain exclusion of $250,000. But she had another $200,000 which she owed in capital gains tax. She owed $30,000 of federal tax and $36,000 for realtor fees. After paying $30,000 in taxes, $36,000 in realtor fees, June is left with $484,000. But don't overlook the 401k. Taxes must be paid there too. That leaves June with $472,000, and Dan, on the other hand, still has $550,000. That's a $78,000 difference. Do you think that's fair? Let's take a look at another example where the assets were not equal. Jane came to me 3 years ago after her divorce. She had received $100,000 in property from her divorce in a stock account. Her husband, Frank, received $100,000 in property. However, this property was all cash. She didn't have enough money to pay her monthly bills. So she had to sell the stock, which it highly appreciated. When she sold it, she was subject to capital gains tax of $15,000. The cash her husband received was tax-free when he needed it. Was that equal? No, that was not. And if you don't understand how these taxes are going to impact property that you receive, you may be left holding the bag for the tax man. And the bottom line is you need to understand how these 3 sources of money, child support, spousal support, and property, will impact your ability to cover your short cash flow needs. This is where a certified divorce financial analysis comes in. We analyze and illustrate the short-term implications of the different settlement proposals by factoring in expenses, investment earnings, taxes, and inflation. Our clients then are able to make educated decisions about their financial future. And remember, you only get one chance to negotiate a property settlement. Can you afford to make this mistake? And we talked about the short term and obvious. Now let's talk about the long term and not so obvious. I find that most of my clients focus on getting through today in the hopes that tomorrow will kind of look after itself. Remember, you only have one shot at a property division. So you better make sure that it works for you, not only today, but 10, 15, 20 years from now. And with regards to financial stability in the future, anybody concerned about your retirement and how that's going to impact you in the future? Because there are several sources of income that may be available to you in your retirement. And I'm going to briefly cover two different retirement plans for employees, as well as I'm going to touch on Social Security.
Hey, Wes, before you get into that, can I ask you a quick question?
Sure.
So you're talking about, these divorce negotiations and settlements. How difficult is it, if, I don't have experience or knowledge of this, but I'm just imagining, a couple going before the judge or a mediator. One presents this option. How much fighting do you expect to see? Like how much more in legal fees are these people going to have to deal with if they come back to the table and say, actually, no, I want to renegotiate? What's that system like? What do people expect to experience there?
Yeah, so it depends on when I get entered into the process. In the beginning stages, it makes it much, much easier for the attorney. When I go in with those documentations, it makes his job very, very easy because he has something to fight for. But when you're going through the process and you don't have those documentations in place, the client could be a little wishy-washy and doesn't know exactly what they want. That's where it becomes very hard.
Yeah.
They tend to change their mind a lot when they don't have a plan in place. So by me giving them those options and them knowing what the outlook is going to do for them, they're typically very strong in what they want.
Got it. I also have one other question about the modifiable and non-modifiable. What does that apply to? Does that only apply to child support and alimony, or can that apply to the way property is distributed as well?
So it's going to apply to income based on the scenario. Child support, if somebody changes their job and they're making more money, child support can increase. It can also go down if they lose their job. So that's usually modifiable in the circumstance.
Got it.
Property is not, because once that divorce decree is signed, that's what you get.
Got it. Okay, cool. Thank you. I'll
Okay.
let you go on.
Well, very good. So talking about retirement plans, the first and easiest to understand type of retirement plan is called a defined contribution plan. These types of retirement plans have an actual cash value today. 401ks are a kind of defined contribution plan. As an employee, you're putting in pre-tax, but sometimes you're putting in post-tax dollars into these accounts, and they grow income tax deferred until you retire. You usually can't access this money until age 55 or 59 and a half without incurring a 10% penalty for early withdrawal. When you get a divorce, however, there's a little known window of opportunity to access your spouse's accounts before retirement without triggering that penalty. If you need liquid money now to cover your cash flow needs, you may want to consider this option. However, I do want to caution you, you need to know exactly how much you need up front. And here's an example. I helped one client figure out that she needed $80,000 in cash from her husband's IRA so she can maintain a cash flow over the next 10 years. She was awarded $150,000 from her husband's IRA pursuant to the divorce decree. She requested a one-time distribution of $100,000, and the remainder would be transferred tax-free to her IRA. The IRS withheld 20% of the $100,000 distribution, but she avoided the penalty. If she decided the following month that she needed another $10,000, it would be too late to avoid the penalty. Once it goes into the IRA, it's no longer an option. So if you're going to use this option, you need to be, make sure you know the exact amount that you need. You cannot do this with your own IRA, only your spouse's. Another type of retirement plan is called a defined benefit plan or a pension. This type of plan is where employees work for a company like Ford Motor Company for 25 years, and at retirement, he or she is promised a certain monthly income for the rest of his or her life. Generally, you can't access the money until you retire, although some plans do allow for a lump sum transfer at a time of divorce. And as I said, you can't actually access the money from a defined benefit plan or a pension until you retire. So what could be wrong with that? Well, if it's part of a divorce settlement that says you get half your spouse's pension at age 65, but you run out of money at age 50, well, there's a gap there. You better make sure that option works, right now for you, but you can also obtain a present value for that pension and receive other assets in exchange. Then again, maybe that would jeopardize your ability to retire comfortably at a decent retirement age. Again, every situation is different. And if you want someone to look at your specific needs, you need to know what it's going to do for you. And the point is, you need to know how every decision will impact your entire financial picture. If you don't know how to answer these questions, how are you going to make those educated decisions? A qualified domestic relation order, QDRO, it transfers assets from a plan's participant, a RISA governed plan, into an alternate payee. If you will be receiving a future deferred income stream from a RISA governed plan, you will need a QDRO. RISA governed plans include 401ks. They also include 403bs. Another potential source of income for in your divorce potentially is Social Security benefits. Again, there's some specific rules regarding divorce. If you've been married for 10 years or more, you will be entitled to half your spouse's benefits or all your own benefit, whichever is greater. This does not impact your spouse's benefit in any way, so it's not a negotiation point in a divorce. Let's look at an example. Mr. Smith is going to receive $1,000 per month at age 65 from Social Security. He and Ms. Smith are divorced after 10 years of marriage. She will receive $500 per month, or 1/2 of his benefit at her age 65. This doesn't impact Mr. Smith's benefit at all. He still gets $1,000 per month. Now, if Ms. Smith was working and her individual benefit was $700 per month, she would opt in 100% for her benefit rather than taking half his benefit because it's more money. You don't get both. You either get half your spouse's benefit or 100% of your own. Now, if Ms. Smith marries Ms. Jones and then divorces her after 10 years, for the next marriage, she would also receive $500 per month at age 65. And what you need to know is that the average divorcing couple in the United States is only married for 9.6 years. So if you wait until the clock strikes 10 years, the ex-spouse might have another source of income stream that may be available to him or her at retirement. And if your ex-spouse dies after your age 60 and you're not remarried, you're entitled to a full widow's benefit. Not to give anyone examples here. As a CDFA professional, can help you understand the financial reality that will also empower you to make those better decisions at a very difficult time in your life. Making an informed financial statement will also help you move on to the next phase in your life. And let me show you an example of how a CDFA works with clients to make sure their short and long-term needs are met by a proposal.
Hey, Wes, before you get into that, can I ask you a question from the chat?
Sure.
Okay. So someone says, I purchased a home less than 6 months after being married with non-marital assets. I pulled this money out 1 week after being married from an existing home I owned. He paid nothing in the purchase, and we've been married less than 7 years. Can I claim the money used to purchase the home was an investment and get that back before the split of the proceeds of the home? At the time of the sale, he promised to pay me back, which he never did. That makes sense?
So that definitely gets into some legal questions.
Mhm.
But if that money was purchased, if that home was purchased with money that was separate before they actually got married, then they're gonna be able to keep that separate. But there's depends on how everything was titled
Mm.
and a few other aspects of where that money came from.
So basically, if I got married and the day after we got married, I used my own funds that I brought into the marriage to buy a home, but I put my name and their name on the title of the home, then it would be marital property. Is that right or no?
Not exactly. And that also gets into legal questions and
Got
understand
it.
I'm not an attorney. But
Uh-huh.
as long as you have the documentation that it was separate, that's all you have to present to your attorney. They're going to go to bat to make sure that stays separate property, even though you retitled it into both their names. It gets a little bit touchy in that. So that's
Mhm.
where you need a divorce attorney to understand that. But knowing that a lot of times when I go through a divorce process, people forget about those little things. So I ask
Mhm.
those questions that get brought up, or we can present that to the attorney and they can go to bat for us.
Got it. That makes sense. All right, I'll let you get back to it.
Okay. All right. So here's a concrete example of how a client gets into deep trouble by accepting a settlement that looks fair on the surface, but has serious repercussions down the road. And after being married for 25 years, Kate and Ken Robinson are getting a divorce. Kate's 46 years old. Ken's 52 years old. They have two sons, ages 11 and 7. Kate's take-home pay is $21,600. Ken's take-home pay is $132,000. The marital assets comprise of home equity, $180,000, mutual fund, $92,000, IRA, $212,000, and a business worth $180,000. Kate wants to keep the home and get half the mutual funds and the IRA, which will leave her with $332,000. Ken also gets half the mutual funds in the IRA, keeps the business, which also leaves him $332,000. On the surface, this looks like an equal settlement. They each get half the assets. Ken's offer to Kate looks like this. Looks like it's going to work, but let's examine the long-term implications to see if this settlement is truly equitable. Looking at Ken's spreadsheet, you can see his take-home pay less expenses, including spousal and child support, less the tax deduction of $5,040 per year pre-2019 leaves him with a positive cash flow of $48,720 the first year. The positive cash flow of $48,000 goes into the working capital next year, increasing both his working capital and net worth. Project forward 20 years, Ken will have a working capital totaling more than $1.7 million and a total net worth of over $2.4 million. Kate, on the other hand, is not doing so well. Looking at Kate's spreadsheet, let's skip straight forward to cash flow, which decreases every year from year 1 to 5. Then it turns negative to the tune of $15,000 as soon as her spousal support ends in year 6. She exhausts her working capital in 11 years. She still has the house, but she can't pay the bills. And she can't sell a window to put food on the table. Her net worth starts declining in year 9. By the time she retires, her cash flow is negative $80,000. Her working capital is negative $157,000, and her net worth is $236,000. And these numbers are only going to get worse every single year. Here's a graphical illustration on what we just talked about, showing the discrepancy between Kate and Ken. Ken's net worth is represented by the turquoise lines with circles. Kate's net worth is represented by the red line with squares. As you can see, there's a pretty big gap between them, and the gap only widens every year. Now let's look at the working capital. Here's what Kate and Ken's working capital looks like. As you can see, this is a pretty grim financial future for Kate. So what can we do to help Kate? One obvious answer would be to increase her spousal support, both amount and the duration. So Kate's net worth has definitely improved, but let's look at her cash flow situation. As you can see, Kate's cash flow turns negative in year 11, and then she's exhausted her working capital before retirement. This future is not much brighter than the first scenario. It's clear that Ken can afford to pay more spousal support, both in the amounts and the duration. So let's look at a third scenario. In this scenario here gives $4,000 a month for 5 years, $2,500 a month for 4 years, and then it drops to $1,500 a month for 3 years. And what that looks like, when you read this proposal in the third scenario, looks very unfair to Ken. But when you project it out 10 or 20 years into the future, you could see he still has a healthy net worth of almost $2 million. Meanwhile, Kate's net worth has been steadily increasing, and she tops out at $1 million just before retirement. That's why it's so important to look at the long-term effects of any settlement for both spouses. The wealthier spouse is much more likely to agree to a settlement that shows he or she is doing just fine down the road. Now let's take a look at Kate and Ken's working capital to see if they can afford to accept this offer. As you can see, Kate's working capital remains positive into retirement. Ken finishes up with $1.2 million in working capital, and Kate has about $360,000 to take into her retirement. Kate's financial future could be even brighter if she were able to reduce her living expenses or perhaps retrain for a better paying job. However, this scenario looks good for Ken, and it gives Kate a future that she doesn't have to fear. We covered a lot of information today, but the 3 most important things for you to take away is learn about the different sources of income that might be available to you. Understand how taxes could affect your settlement, and understand the short and long-term effects of your divorce in that settlement proposal. This will allow you to make sound financial, not emotional decisions. In essence, you must understand both the short and the long-term ramifications of the different settlement options. Everyone is entitled to financial dignity during and after their divorce. In order to achieve that, you must make educated financial decisions. Now it's time I want to open up to see if we have any other questions for you. And I know some of you might have to go. Anyone that's interested in learning more of what we went over today, reach out to me and I will give you this divorce survival guide. I'll mail that to you. Has some great information, has some charts, a lot of gathering, a lot of organizing, and I will get that out to you. But thanks for joining the meeting today, and good luck, everyone. You're dealing with one of the most stressful times you're ever going to face in your life. be strong, get the info you need in the beginning stages. Because I see that most people get wore out a little bit later on and potentially start making those bad decisions towards the end of the divorce.
Yeah, that makes sense. Hey, I do have a question for you from the comments, Wes. She wants to know, by working capital, and this was in your previous slide, are you referring to cash? Actually, it was 2 slides ago when you were
Yep.
doing that breakdown of Ken and Kate.
So working capital is anything left over. So I set people up with a budget. We know every detailed aspect of what they're going to spend their money on. And a lot of times we have to tighten that up. But there comes a point you can only tighten up so much. And that extra money that's left over goes into that working capital column.
Got it. Got it. Sorry, I just have to respond to one person here. There we go. You know, another question is, what do you think is the biggest mistake or the most common mistake that a divorcing couple makes?
Whoa, that's a great question. I've seen a lot of very smooth divorces going through this process. I've also seen processes that there's a lot of fighting going on. Nobody wants to negotiate, and it becomes a mess. I would say the takeaway here is you really have to think about your future and try not to make emotional decisions. You know, when you start arguing, things just really get carried away. I had a couple clients ago, this was about 3 years ago. We had a great plan in place, child support, spousal support. He had a job that was paying $350,000 a year. The day after they got a divorce, he ended up quitting his job and has not had another job since. This was 3 years ago. So everything we planned, the spousal support, she's gotten no child support since, that has changed. And, you know, that a lot of things can go wrong, even with these plans in place, but you need to be prepared and have this plan. And if we can't get you to point A to point B, that's where the plan we can adjust and really change the outlook moving forward.
Yeah. Yes, for sure. Interesting. Can you tell me also, what are some things, just generally speaking, that folks can do before they just even decide to get a divorce? What are some things that folks can do to prepare themselves in case something goes sideways?
That's a very good question. And there's so many things. And I do want to recommend this divorce survival guide. I will mail this out to anyone. This has a lot of questions. It has a checklist, and it's really preparing you. You don't have to make a decision if you're going to get a divorce today, but that's going to help you. And it might answer some questions, and it might make you turn the other way and kind of rethink divorce as well. But I'll be happy to get this out in anybody's hands. It's a great little thing. You can read over it in about 2-3 hours, and it's going to help you tremendously for that.
Another question that has shown up here is, you know, you didn't really talk, you talked about assets, you really didn't talk very much about debt. Is there anything that people should be considering about their debt, about the couple's debt, or the or individual debt?
Yeah, so a lot of what I do, I work with people a lot of times that have assets. If it's the opposite and they have a lot of debt, a lot of times that's pretty straightforward. If they don't have assets that they need to value and really look at, the court's just going to split up the debt.
Got it.
Even if your spouse racked up $50,000 on credit cards, that's where your attorney, you'll work with them to really get that debt separated, but that's also your debt. Now, it might not be, the creditors might not be chasing you if you don't pay that debt, but you do have, legal bound after the divorce decree comes out to pay or settle that debt sometime in the future. But where I really help people is somebody that has the assets, making sure they get the better piece of the pie, making sure they're not paying extra on fees, taxes, and helping them that way.
Got it. Well, let's see. I think that is just about it. I mean, for the people who are asking how to get in touch with Wes, we'll reach out to you after the event. We'll send you an email with a recording of this presentation. If you want to meet with Wes or meet with another financial advisor, leave your phone number. We'll give you a call and set you an appointment. So if you could go to that next slide, Wes, we can, oh, I forgot the disclosure slide. We can wrap things up. On behalf of Advice Chaser, I want to thank you, Wes, and also the organizations that worked with us to bring everyone this webinar today. We appreciate you attending. And you can, again, look for that email soon with a link to a replay of this event. And you're also welcome to share that replay with friends and family and anybody you think would benefit. We'll also be hosting this on Advice Chaser's YouTube channel, so you can look for it, the presentation there. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you. Every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. You can find out more about us by going to advicechaser.com and clicking on the link to find an advisor. Thanks again, Wes. Thanks to all our attendees for coming out, and we'll see you at another webinar soon.
Thanks, Megan.
Take care. Bye.